When we look at Europe, they're going to, as we said in segment one, they're going to be the most impacted by really what is happening in Russia, Ukraine, as we see less flow, as we see more pressure, less food, less, everything from fertilizers to energy. So when you look at this, you have to appreciate kind of where we sit. So the survey expectations, I think, are key because last month it was a positive 48.6, and now it's a negative 38.7. So you're seeing a big pivot down. ECB has kept things the same. We didn't see that adjusting. I should say we didn't see that adjusting in this meeting, but given how things have come to light, where the pressure is, how things continue to shift, it is likely to see them start to pivot a bit and starting to get a bit more concerned about where things reside. And I think it's important to look at some of the different components of the broadening and accelerating inflationary pressures. So when you look at where the pressure is and how it's accelerating, again, I know I've said it multiple times throughout this whole podcast, if you're listening to it once through. The problem is all of this is happening prior to a renewed impact on the supply chain. So anything that has happened is only going to get worse and get pushed up, especially in Europe. And Europe is a place that was already struggling compared to the US, and I have charts on that to just show you kind of where things are now and where things are going to continue to go. So then the household nominal income in the US, it's above where it was pre-COVID. Euro area, it's below where it was pre-COVID. Savings rates, US has now come into the negative territory. Euro area, going to do the same. And that's where you look at the consumer. And just look at where the Euro consumer was going back to 16, 17, 18. They were not in the same position the US was on a household nominal income level. So they came into COVID in a worse position. And now, realistically, they're going to get hit hardest by Russia, Ukraine. The US will get hit, the world will get hit, but Europe is going to get hit like right on the nose when you look at where some of these impacts are, which is why we're going to continue to see these pressure points. Real private consumption. US has gotten back to normal when you look at it on the private consumption. We think it weakens, but we had that snapback. Euro area has not gotten back to it. And when you look in 2019, it was already starting to fall off of that pivot prior to COVID. Real private investment. US is off of the normal rate, but look how deep Euro area is. There's every piece of the European pie that makes up GDP is showing just more and more pressure, and it's unlikely they're going to be able to make up those components. Euro area goods and services, again, kind of arching back in. The services we think are just going to kind of slow down. US, something similar. We think services will slow down, goods will accelerate down, and you'll start to have some of this meat in the middle. But look at Euro. The Euro area never went as high as the US. Again, some of these different pieces that keep those pressures. Household nominal income, again, just reiterating the fact that on the household front, we're just not seeing the same impacts. And the same impacts falling short creates this underlying issue in terms of spending, in terms of where is money going to come through? How are our manufacturers going to be able to pay given where gate prices are going? Which is then leading to that slowdown in real consumption. And the consumption is, and I know that I've repeated some of the charts, but I just wanted to reiterate these facts because I think it's so important when you look at all of this was happening during COVID. Now you have a renewed issue, and all of these backdrops just continue to point to additional slowdowns, additional pressure levels that we don't see getting any better anytime soon. So Euro area disposable income is lower than its pre-pandemic trend in contrast to the US, and this is just putting it into context when you look at it on a bar chart. So then the business cycle starting to look shaky again. So the Euro area Bloomberg consensus GDP forecast is still elevated, but expectations have come down. Now, for those that have been listening to us talk and us go through these different pieces, if you remember, I had said that the Europe wasn't ready for a recession, that they were going to kind of bump along the bottom. Things were going to do what it was. We weren't going to get an actual recession yet. That has now changed. There will more than likely be a recession, and a recession on economic terms are 2 consecutive quarters of negative growth, which we think is very likely at this point, given the pressures that we've outlined. Now, CPI, everything for the most part came in line with expectations, but that was February. March is going to be a whole different world of can of worms. Wholesale prices, same thing, going higher. But it's reflecting in the survey expectations, because the expectations that was expected to be a +5 came in at -39.3. Current situation right in line for the most part. Again, all of that just showing you the pressure and fear that is starting to build in. And if you're fearful, you're not spending, you're not buying, you're not investing. And those are things that are going to continue to be, I think, a continuous problem when you look at what is coming through the market. And this just puts it into perspective. It's at the low points that we were at in 2020. Same thing with economic growth, and it's unlikely to see that adjust. You can see that it's coming into where it was during the European financial crisis, the global financial crisis. Again, all of these pieces just showing where that pain and pressure remains. Then you look at the Eurozone and just where it is in negative. It's not where it was for 2020, but you get an idea of where it is in relation to other slowdowns and how 2019, because as we said earlier, Europe came into COVID at a weak point, and it hasn't gotten any better since. So then when you start looking at German manufacturing orders, they had a nice bounce. Industrial production, same thing. That will have another bounce in February because there's a big backlog for cars, for German and equipment. But that is also going to slow down as we have the pressure that is arising in March and beyond. Volkswagen, just an example. Volkswagen has a 7,000 person facility in the Ukraine that does wiring harnesses for cars. How are you going to replace that? Again, a lot of these impacts just continue to reverberate through the system. Market construction PMI came in at 54.9. That'll stay elevated. That'll start to come down in March, but still, we don't think that goes negative yet because construction, if you remember, has been an underwhelming period since COVID. So now it's finally starting to catch up as you had some raw materials. So some of the some of the inventory has been built up. With that buildup in inventory, you're going to start to see that get whittled down and through. So German 10-year break-even, again, surging higher. That's something that is going to continue to be the case, especially after the Fed, what the Fed has done in terms of the rates and where rates are going in general. Then when you look at the Eurozone CPI, just to give you an idea of on a Eurozone level, just how elevated things are. The survey was for 5.6%, came in at 5.8%. Core was expected 2.6, came at 2.7, surging back to the highs for February. And it just means that March is going to be that much more fun. As retail sales are now back below the trend area for January, you could get a little bit of a pop in Feb, but you're likely to see 2 months of continuous degradation on that front. And then Eurozone PPI surging to the highs. Survey was for 27.3, came in at 30.6 for Jan. Just is showing that we're going to have more pressure, more to come in Feb. February got worse than January. March got worse than February. So again, you're seeing how these gate prices and how this is only going to feed the inflationary beast that we continue to see in Europe. Italy service PMI was expected 52.5, came in at 52.8. Spain's PMI was expected, service PMI was expected 51.6, came in at 56.6. We expect that to still be an expansion, but again, coming back down based on what has happened throughout the continent. This is just showing you that ECB staff projections are going to have to change. And I always love how the central banks have these like pretty little charts of, very even if it's an extensive increase, it's a very accelerating downside. It's like, well, what world are you guys living in? Because it's definitely not the one that I'm spending money in. So this is where we continue to see those pressure points, and we think those expectations will have to change. And one of the key pieces of that is the spark spread. Short-term electricity prices have surged 1,000% in many countries in Europe, including in France, where they hit a record high of 560 euros per megawatt hour. again, you're talking about serious problems, which is why they're bringing back nuclear. They're looking to reverse things to try to find ways to get off of Russian gas, Russian oil, to avoid some of the issues that we've continued to see and problems that remain within the system as Europe continues to struggle under just any type of growth. It's just trying to manage at this point, let alone grow, just trying to find a way to survive. So that's what we have for you for Europe. In the next segment, we're going to go into China and Asia in general to look how things are shifting on the other side of the globe.